The gap. Imagine you're watching a race on TV and all of a sudden there is a 1 second lag, and racer number 19, which was last, now becomes first. That sudden jump or fall is like a gap in trading. A gap is when a price of the stock makes a big leap or a big drop in between 2 points in time, basically 2 candles, instead of gradually changing. This then creates a gap between the candles. Now gaps most of the time happen between trading days or trading weeks, and the reason for that is because, as I mentioned earlier, we have something called after-market trading and pre-market trading, and most of the brokers don't display the price action that occurred in those sessions. Now there are 2 types of gaps, which is gap up and gap down. A gap up is when a stock price opens higher than it's previously closed, and a gap down is the complete opposite, where the stock opens lower than it's previously closed at. So for example, let's say a stock closed at $100 and opened the next day at 105. In that case, it's going to be a gap up. And if the same stock opened the following day at 95, it's going to be gap down because it has opened lower than what it previously closed at. But why and how gaps happen? Now gaps happen for various reasons. It could be because a lot of people suddenly want to buy the stock or sell the stock because it released a good or bad earning report overnight. And as we know, things happen in the market after it closes for us. Then, when the stock market reopens, the stock price is not going to be priced the same. It's going to be priced based on the new information we now have. And, of course, supply and demand. Because, as we know, if the company releases a good report or good news, more people will want to buy and will be willing to pay higher prices. And if the company releases bad news, the other way around. And lastly, of course, how can we benefit from these gap ups and gap downs? Now, after a gap, a lot of things can happen. One of them being, after a gap up, the stock might continue to rise, which will signal a strong uptrend. And then we can just join and enjoy the ride. A good recent example for that can be Nvidia. Another common situation is the stock price will go down in order to fill in the gap, which basically means the stock will go back to the price it started the gap at. In our example, it was $100. Now, of course, these scenarios can happen with a gap up and a gap down. So do keep that in mind.